Welcome back to The Explainer. Today, we're stepping into an absolute arena of volatility. You know, if you felt the ground literally shake under the crypto markets on July 24, 2026, well, you definitely weren't alone. We've got these vibrant comic book level clashes happening right now. Bulls versus bears, DeFi pushing against macro headwinds, and infrastructure battling these unseen exploits. We're going to break down exactly what just tore through the ecosystem.
So what happens when global tensions, $225 million in outflows, and a three-pronged hack hit the market on the exact same day? Let's dive right into this explosive question. Because honestly, what we're looking at here isn't just a bad Tuesday. It's a perfect storm. We had geopolitical shockwaves, institutional capital suddenly hitting the brakes, and critical infrastructure taking massive damage stats, all converging in a single 24-hour window. To really grasp the magnitude of this shakeout, we've kind of got to pull back and look at the whole battlefield from a wider angle.
Section 1. The Macro Market Shakeout. Bears enter the arena.
Before we even look at crypto, we have to look at the massive macroeconomic forces attacking the global stage. You know, you can't understand digital assets in a vacuum, especially not today. The bears didn't just enter the crypto arena, they crashed the global equity markets first. $800 billion. I mean, treat this as a massive critical damage stat. That's the amount of market capitalization wiped out from the Magnificent Seven tech giants in a single day, their worst performance since April 2025. This was a violent, overarching risk-off shift across U.S. equities. And when traditional tech takes a hit this heavy, that shockwave absolutely blasts right into the crypto space.
And you know, it wasn't just tech earnings dragging the mood down. We were hit with a rapid-fire barrage of macro threats. First off, geopolitics. Iran rejected a proposed U.S. ceasefire plan, which obviously escalated tensions and the potential for military operations. That instability instantly spiked energy markets, pushing Brent crude oil straight past $101 a barrel. Then domestic data just added fuel to the fire. U.S. jobless claims plummeted to 187,000, which is a nearly four-year low. Now, a strong job market sounds great, right? But in this arena, it dramatically boosted expectations for a July Fed rate hike. Higher oil fuels inflation fears, which pushes Treasury yields up, which violently suppresses the appetite for risk assets across the board. The result is pure dynamic friction.
The really crucial point here is this: that global macroeconomic shockwave directly dragged the overall cryptocurrency market down with it. It took a 1.3% hit, bringing the global market cap down to $2.3 trillion. So the broader market definitely got caught in the crossfire of this macro retreat. But the most dramatic battle of the day? Well, that happened right in the center ring.
Section 2. Bitcoin's inflow streak ends. The heavyweight clash.
Let's zoom in on the main event and look at the sudden, really jarring reversal of institutional momentum. $225.2 million. Boom. That represents the net outflows from U.S. spot Bitcoin ETFs on July 24th alone. After days of nonstop buying pressure, institutional demand didn't just pause, it violently reversed course, landing a critical blow to the bulls.
And this brilliantly illustrates why that number is so shocking. This outflow completely shattered a powerful 7-day, $1 billion inflow streak. I mean, just days prior, institutional demand seemed like this unstoppable juggernaut, pulling in hundreds of millions a day. This sharp pivot leaves everyone asking, is this a one-day tactical retreat because of the macro storm, or is it the beginning of a larger institutional exodus?
That massive ETF outflow translated to some real-time combat on the charts. Think about that $65,000 mark. That wasn't just a number, it was a literal defensive shield for Bitcoin. The price actually broke, dipping down into enemy territory at $64,600 before the bulls rallied and fought their way back up to a high of $65,403. It's this high-stakes tug of war, with buyers and sellers locked in a short-term equilibrium right on the edge of that critical support level.
Section 3. Ethereum and DeFi. DeFi, the counterattack.
So if Bitcoin was taking heavy fire, get ready for a surprising, really resilient counterattack. Because while Bitcoin ETFs were bleeding $225 million, US-listed spot Ether ETFs quietly extended an inflow streak of their own to 5 consecutive days, adding another $26.3 million in net inflows. This is wild. It proves that institutional Ethereum demand has its own independent momentum right now, completely ignoring Bitcoin's struggles.
And leading that specific counteroffensive was Fidelity. Their FETH product captured almost $15 million of that fresh capital in a single day. Despite the macro storm howling outside, investors were actively rotating capital into Ethereum products. But, it wasn't just ETH showing incredible resilience.
The decentralized finance market absolutely surged, escalating an astonishing 9.8% to hit a $63.4 billion market cap. While the heavyweights were stumbling, DeFi was sprinting. And this suggests a really strategic, aggressive capital rotation. Investors aren't just fleeing to cash, they're seeking alpha deep within decentralized protocols, finding these pockets of extreme resilience in a sea of red.
Section 4. Hackers' Day Security Fallout. Chaos in the Ranks.
Now, this explainer wouldn't be complete without covering the chaos operating in the shadows. Just a day prior, on July 23rd, the industry took a severe critical hit. $35.5 million. That is the combined total lost across 3 major DeFi protocols in just a 6-hour window. This wasn't a gradual bleed. This was a coordinated, rapid-fire sequence of exploits that absolutely left the industry reeling.
When you look at the mechanics of the attack, you see a clear pattern. The attackers didn't break the underlying blockchains. No, they went after the vulnerable seams connecting them. They targeted cross-chain bridges and off-chain systems. Protocols like PancakeSwap and FX Trade suffered consecutive hits, resulting in an estimated $27 million in losses alone. It's a stark reminder that as our infrastructure gets more complex, well, the attack surface expands.
Which brings us to this incredibly grounding quote from a Blockman.pro report analyzing the attacks. Security is not defined by how platforms respond after attacks, it is built long before attacks happen. So, what you should really take away from this is that security is a proactive, shared responsibility. From the developers writing the smart contracts to the users evaluating platforms, building a resilient ecosystem is everyone's fight.
Section 5. Navigating the Regulatory Void. The Final Boss.
If the macroeconomy is the battlefield and hackers are the hidden traps, regulatory uncertainty is for sure the final boss, threatening to keep institutional capital completely sidelined. The SEC is currently racing to propose new rules for token offerings and custody by the end of July, leaving compliance teams just holding their breath. Meanwhile, legislative efforts are totally stalling. Senator Elizabeth Warren has criticized the latest draft of the Clarity Act, effectively labeling it dead on arrival. Furthermore, the Senate Majority Leader indicated that this vital legislation is expected to miss the congressional summer recess window entirely. This massive lack of legislative progress creates a fog of war that makes large-scale institutional investment incredibly difficult to justify. So how does the market feel about all of this? Well, 28. That is the current score on the Crypto Fear and Greed Index.
The crucial point here is understanding what this score actually means for the battlefield. A drop from 31 down to 28 pushes the market deeper into fear territory. It perfectly synthesizes everything we've looked at today. The geopolitical shocks, the sudden ETF outflows, the $35 million infrastructure hacks, and that looming regulatory void have left investors deeply anxious and extremely cautious.
Which leaves us with this final high-stakes question hanging over the market. With macro headwinds howling and traditional equities looking shaky, can Bitcoin rally its forces to reclaim and hold that critical $65,000 support shield? Or is this vibrant, chaotic shakeout just the opening scene of a much broader, punishing reversal? The bulls and bears are locked in an equilibrium right now, but the next volume breakout will decide the victor. Keep your eyes on the charts because the next move is gonna be massive. Thanks for joining this explainer, and we'll see you next time.